You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIWTweets.
Hello, welcome to The Investor Way with me, Sam Ball. I'm joined by my co-host, John McEwen, and it is the 25th of July, 2022. In this week's episode, we're going to be discussing Ocado, Frasers, Money Supermarket, Britvic, Hotel Chocolat, and Netflix. John, should we start with favourite of the show, Ocado?
Yes, go on, Sam.
So, Ocado have come out with their half-year results, and half-year revenue fell 4% to 1.3 billion. A strong growth in international solutions and UK solutions and logistics couldn't offset declines in Ocado retail. Increased investment in building out customer fulfillment centres and higher costs from labour, utility and fuel contributed to a loss before tax, which increased from 27.9 million to 211.3 million. The group remains on track to deliver full-year guidance and isn't expecting to need further financing in the medium term. Ocado Retail, which is jointly owned with M&S, saw revenue fall 8.3% to 1.1 billion. That was driven by a 13% drop in customer basket value as the cost of living crisis compounded the ongoing normalisation of shopping behaviours. Active customers grew 11.6%, and Ocado's share of the online grocery market increased from 10.8% to 12.1%. Higher operating costs contributed to EBITDA falling from 104.1 million to 31.3 million. UK Solutions and Logistics saw revenue increase 38.3 million to 395.6 million, with fee revenue 8.9% higher to 79.7 million. Average orders per week increased 6.5% to 491,000. By the end of the year, the group expects to have capacity for 800,000 weekly orders. Cash profits decreased 1.5 million to 28.6 million, largely due to the continued rollout of the Ocado Smart Platform and significant cost inflation. 6 new customer fulfillment centres went live in international solutions, helping revenue more than double to 58.5 million. The division signed 1 new partner over the period and expects a strong pipeline of further commitments from existing partners. Cash losses were 1.1% higher at 57.2 million as the group continues to invest in expansion. There was a free cash outflow, including lease payments of 405.2 million. Net cash at the end of the period stood at 758.8 million, following the 578.2 million share issue in June. In terms of valuation, there's no earnings. The business trades at a forward price to sales ratio of 2.1 compared to a 10-year average of 2.8, and there's no dividend. My thoughts are this is quite disappointing. I appreciate that online shopping has seen a pullback as stuff's reopened and people have started going out, but this is a growth stock and revenue is falling. Yeah, then on top of that, the UK Solutions revenue increase, where it's doing it for others, that's only up, 10%, which I don't think is particularly impressive. The international solutions is interesting, but that's still very small, so it's too soon to say how useful that actually, how much that could actually contribute. And I think as well, when management are making comments like isn't expecting to need further financing in the medium term, that's very concerning because this is a very capital intensive business. They have just done an equity raise, and they did it in June when the share price is about a third of what it was 18 months ago. And I just don't, hindsight's a wonderful thing, but I don't understand why, when they knew what the rate of cash burn was already, why management weren't doing an equity raise at the highs, and a big one too. Because at one point they were valued at more than Tesco, and they may never be valued at more than Tesco again. I think it's very, very poor from management to not do the equity raise when you know you're going to run out of cash in the near future until the stock has dropped by 2/3. John, what are your thoughts on the results and the valuation?
Yeah, I mean, I think they were poor numbers for a very highly valued business. And then, like you say, there's that sort of question about management. And I think but overall, even if you look at the longer term, what future do you see in their technology, and how much do you value that? It's not, I think for me, it would be one that I just wouldn't invest in, but it is interesting. And I think the most interesting thing is really watching some of that technology and watching some of the what goes on in the warehouses or the fulfillment centers on their website. But for me, not an investment.
I just think as well, like with the M&S investment in 50% of Ocado retail, I think they've got the worst bit of it. I don't know, maybe because they wouldn't have done a deal otherwise, but I don't know why they weren't pushing more. Because if they had 50% of the international solutions or the whole thing, you'd look at it and think, well, maybe that could come good. But the 50% in Ocado retail, I think that's just going to be a write-off, or a large chunk of it is.
Yeah, and I suppose at least M&S is doing better. But yeah, not good for them.
No. Right. Shall we move on to Frasers?
Yes. So Frasers Group, and I think this is the first time that it's been on the podcast, is the FTSE 250 retailer that's best known for Sports Direct. And they had their full year trading update for the 52 weeks to the 24th of April out last week, with full year organic revenue rising 31.2% to £4.7 billion, excluding the impact of exchange rates, with opening of the retail estate again after COVID restrictions. Revenue in the core UK sports retail business rose 31% to £2.58 billion, with gross margins increasing to 43.5% from 42% the previous year. In the premium lifestyle division, revenue rose 44% to just over £1 billion, whilst gross margins remained static at just under 45%, with new flannels stores and continued growth online. In the European retail operation, revenue grew by 28%, coming in at £790 million, with gross margins growing to 42.7% from 39% last year. The rest of the world retail, however, fell by 1.6% to to £150 million, and profit before tax came in at £366.1 million, compared with just £8.5 million last year. Operating cash flow before working capital came in at £795 million. A statement from Michael Murray, the chief executive of Frasers Group, said, "I'm really proud of the record performance we've announced today. It's clear that our elevation strategy is working, and we're building incredible momentum with new store openings, digital capabilities, and deeper brand partnerships across all of our divisions. We've got the right strategy, team, and determination to keep driving our business from strength to strength." And in terms of outlook, we're delighted to report a record-breaking year for Frasers Group, with adjusted profit before tax £344.8 million, despite the significant economic headwinds and well-chronicled challenges across the sector. Our elevation strategy has remained laser-focused, and we have restructured our team to execute it with conviction. It is underpinned by our core strengths and rock-solid foundations. Although the backdrop remains challenging, this momentum gives us confidence of achieving adjusted profit before tax of between £450 and £500 million for the next financial year. In terms of valuation, Frasers Group has a market capitalisation of just under £4.5 billion and trades at around 13 times earnings, compared with a 10-year average of 16. I thought these results were good, albeit against weak comparators with those COVID lockdowns in 2021. And it's also got some strong brands like Jack Wills, Slazenger, Everlast. And I think strategically, it'd probably be quite well placed to take advantage of a downturn, or perhaps sort of relatively well protected against one, as we saw in the early 2010s. But I suppose ultimately with Frasers Group, it depends on what your view on bricks and mortar retail is, because it has so much of the high street. And there are some bits, whether it's Jack Wills, Sports Direct, that are more attractive than other parts, like Game, for example, which is a traditional bricks and mortar video game retailer, which is a lot less strong. And I think there's probably less of a case for it. But certainly when you look at the management there, they're less conventional and probably have some corporate governance issues. But Mike Ashley and his family do seem to be able to produce the goods. And if you look at the long-term share price and revenue growth, earnings growth, it's really impressive. And I know Sam and I several years ago, I had talked about Frasers Group when it was then Sports Direct. I think it was, I remember it quite well. It was £2.76 the share price, and you were quite bullish on it then. And we're now over £9 a share. So it would have, I don't think did you actually invest, Sam?
I did own it at one point. I can't remember why I got rid of it, but I basically, I think I about broke even on it, maybe made about 10% or something, but yeah, I can put that in the list of regrets.
Yeah. What did you think of the results, and what do you think of Frasers? It's not a company that we've covered before on the show.
No, I thought they were good results. I think even if you forget that the comparatives are quite easy, they are pretty decent results. And I don't think the valuation's outrageous, providing you're not, you don't think the future of the high street is cataclysmic. I didn't know they owned Game actually until we did this, but I didn't realize they had Game. I didn't realize they had Carrymore either. That's quite a decent brand actually. What's House of Fraser? Is that clothes?
Yeah, so it's a sort of department store.
I thought it was. Obviously, as you can tell, I don't shop there. If you were long like the UK high street and you were quite bullish on it, I think you'd probably just be able to buy Frasers and just leave it at that, because it's got so many of the brands that it basically is like a fund for the high street. I don't think the valuation is outrageous. It's not the sexiest stock, but it is delivering. I probably wouldn't buy it. It doesn't pay a dividend either, so I don't think, or it hasn't historically, so I don't think you'd buy it for the income. I don't know if it maybe just cut it because of COVID, actually. I'll just have a look at that. On the HL finance page, it's not paid one for the last 5 years. But I think when I had it was about 2016, 2017. They were having problems then, so it could have been, if they were paying it, it must have been pre-2017. It looks like a decent business. It looks like it's in pretty decent shape. I think if I know I said what I said earlier about if you wanted exposure to the UK high street, but I think there's better brands on the high street that you could get. Like, I think I'd rather have Next. I'd rather have Kingfisher. And there's probably a few others like that I'd rather have. But it looks like a decent business.
Yeah, fine. Do you regret not holding?
I do now see what's happened to it. Whatever I bought instead probably didn't do as well.
Well, I do. Yeah. Oh, was it for Snapchat? Did you use that?
Could have been Snapchat. It was about the time I bought Lysergic actually as well.
Oh, okay.
Could have been Lysergic.
Anyway, we're going off. This might be cut.
We're going to a stock I do own.
Yes, let's go on to Money Supermarket.
Yes, so Money Supermarket, the price comparison website, have come out with their interim results. Revenue was up 19% to 193.2 million. Profit after tax was up 20% to 33.7 million. Basic earnings per share was up 18% to 6.1p a share. Operating cash flow was up 31% to 45.9 million. The revenue growth of 19%, that was only 2% if you exclude the Quidco acquisition. And they've put that down to strong performance in money and travel channels, partially offset by the closure of the energy switching market, which was I think it was about a quarter of the business or something like that. Car and home insurance markets are yet to reach a steady state after the introduction of the FCA general insurance pricing regulations in January, with initial evidence of lower market switching volumes. Gross margins are down 2%, driven by expected mix effects, particularly from the Quidco acquisition. They've highlighted a strong cash conversion with 45.9 million of operating cash flow on 193 million of revenue. Net debt of 69.1 million reflects the Quidco acquisition. The interim dividend was maintained at 3.1p, which reflects a confidence in growth prospects and continued good cash generation. In the outlook, they've said our first half performance was ahead of expectations, and they've also said we continue to expect energy switching market to remain closed this year. And there were a few interesting points in the slide. So their reinvestment rate is unchanged at 13%. And that's one of the annoying things about this business. It's a fantastic business, very, very high return on capital, very, very good cash flow, but the market's pretty saturated and there's not really much they can do to grow it. So most of the earnings just come straight back out as a dividend. And unfortunately, they can't reinvest it for you at the returns on capital they're currently getting. But at least they're smart enough to pay it out, which a lot of management isn't in a lot of businesses. And then in the revenue, The insurance was up 7%, with travel trading above 2019 levels and offset by market-wide lower switching in car and home. There was strong growth in all money channels. Banking product offers are particularly attractive, and good momentum in travel recovery. So the travel revenue was up 698%, but it was off a tiny base, and it still makes up, it's about 1% of the business, so it's still tiny. Home services was down 59%, money was up 50%, and insurance was up 7%. In terms of the margins, the gross margin is now 67.9, and that's down from 70.1. All that's mainly due to the Quidco acquisition, as mentioned before. They have helped households save £900 million in the half, and that compares to 800 million a year ago. Net promoter scores up from 71 to 72. The marketing margin is down from 61 to 57%. Active users is up from 10.2 million to 10.8 million. Although that did see a drop off last time, but I think that's mainly due to stuff like the energy market closing. A lot of those users that were there a couple of years ago, if the energy market actually normalizes at some point, a lot of these deactivated users will probably just come straight back. The revenue per active user was £15.86 compared to £17 a year ago. In terms of the valuation, the business is trading at a PE ratio of 21 on the actual earnings, or 17.5 if you use the adjusted, and this is still on reduced earnings. If energy comes back, for example, that would make a big difference. It's 21 on actual earnings, and the stock is currently yielding 5.19%. I thought these were very good results in the circumstances. I'm very happy with the way management are operating. I think the energy market will come back at some point. It's just, it might take a couple of years, but I think what I like is it's demonstrated just how resilient this business is and how diversified. Because although a lot of what it operates in is similar, I don't think there's one part of the business that makes up more than like 30% of revenue. So if you get that kind of hit from regulation, or what we've seen going on with energy, or the new rules of car insurance, it's able to adapt. And I think the management have done a very, very good job with this business over the last few years. So I'm quite a happy shareholder, and I intend to continue holding it. John, what are your thoughts on the results in the business?
I mean, I thought they were really impressive results, and I think the market did as well. And it's interesting just in terms of, I suppose, the macro situation that's going on, and actually hearing Martin Lewis, the founder, talking a lot about how tough times are and how you can save money, and basically comparison websites coming into that. I think it's also interesting from the energy market, which at the moment, I think the price cap is probably still cheapest for a lot of people, but there are some fixed price deals coming back in. And you also wonder, with the change of leadership in the Conservative Party, the governing party, whether there's going to be a new energy policy, just because it hasn't been working with the price cap, and you've had all of those independent suppliers essentially going bust, whether they're going to sort of, I suppose, return to competition in the market once again. I think that's interesting. And if they did, I mean, you'd see another revenue stream really coming back strongly for Money Supermarket. So yeah, I think the business is in a good position. Obviously, with the way things went in the last 2 years, it was badly hit, but it's coming back. And I would be optimistic on the long-term prospects. So yeah, I'm certainly more bullish than I've been on Money Supermarket in a long time.
Good enough for the watch list?
I think so, yeah. I'd like to have caught it a month or two ago, but anyway, it's easy to say. It's these good results, seeing management strategy come through.
The last results were good as well, actually. I think we covered them. Before that, it was a bit shakier. But yeah, no, they are, I think management are doing a very good job.
Yeah.
Should we move on to another watch list stock of yours then?
Yes, I know. Again, one that I haven't pulled the trigger on, but Britvic. So we've covered it a lot of the time, or a fair few times on the show before. It's a soft drinks maker listed on the FTSE 250. It includes brands like Fruit Shoot, Robinsons, Tango, J2O, and it has the license for PepsiCo brands in the UK, like Pepsi itself, 7-Up, Lipton Iced Tea. They had their Q3 trading statement to the 30th of June out this week, with revenue up 11.2% to £431 million, with volume growth and positive price mix. And this was driven both by a larger off-trade British market sales, which grew by 9.2%, and the expansion in Brazil, which grew by a more impressive 24.3%. Other international was up 12.7%. And commenting on these results, the chief executive, Simon Litherland, said, year-on-year performance in the quarter reflects continued resilience demand of our portfolio of trusted family favourite brands. This summer, we have a range of exciting marketing campaigns across all of our markets, including a major new campaign for Robinsons in the UK, and we will be bringing back Pepsi Max Taste Challenge for the first time since the start of the pandemic. We are encouraged by trading performance year to date, although we expect the uncertain environment to continue and weigh on consumer confidence. We remain focused on mitigating the impact of inflationary pressures on our business. Soft drinks is a resilient category within which we have a well-invested business, a flexible operating model, and a robust supply chain. We're confident in our ability to deliver value for all stakeholders, full year performance in line with market expectations. In terms of valuation, Britvic has a market cap of around £2.2 billion and trades at just under 20 times earnings. It's one that we've talked a lot about on the show before. We like the brands. They've got very healthy margins and they've got decent revenue and earnings growth. And probably the most exciting part of the business, certainly if we compare it with its main competitor in the UK, AG Bar, is that it's got that growth in the emerging markets, but particularly Brazil. I think it's delivering on the expectations, and it's certainly not cheap at just under 20 times earnings. It's one I still like, but I haven't coughed up for just yet. I think it'll probably still stay on my watch list, but not to say I don't like it. Sam, what are your thoughts?
It's similar to you. I think the figure that stood out to me the most was the Brazil revenue up 24.3%. I think is it just a trading statement, this?
Yeah, it's just a trading statement.
Yeah,
so
there wasn't all that much. We won't have the actual breakdown, but when we looked at it last time, this isn't off a small base. The Brazil revenue makes up a very significant part of the business already. So to be delivering those kind of figures, I think it's really, really impressive. And that could be it could probably be a bigger market than the UK, just based on the size of it. I know it's still developing, but no, I really like it. I much prefer it to AG Bar. I think it's got better brands. It's operating in better markets. I think it's just a better business generally. I don't like 19 times earnings though, but it's for a quality business. You've got I understand why it trades at a premium. What does AG Bar trade at the minute? Because they're usually pretty similar, which I never quite understand. So I don't know if it's got half year results or something that aren't factored into this, but just straight from the HL page, AG Bar's trading at a P of 22. So I'd pay less for Britvic, which is a better business every day of the week. But yeah, I'd like it a lot more if it dropped 30%, but I understand why it hasn't. It's a very, very good business, very, very good operator.
And with numbers like that, it's probably not going to. If it keeps delivering, it's not going to.
I think it's the kind of stock that you want to have on your watch list, and then when you get like a scenario like we've got now, where you've got like the inflation, whatever else, and everything's getting dragged down, and the good businesses are getting dragged with the bad. These are the kind of businesses I think you want to be pouncing on, where it's the good businesses that have just been pulled down because like we're in a recession or something like that. But no, I really the share price performance actually in the last 5 years hasn't been very impressive, but I like the business a lot.
Yeah, and you should be guided by the business rather than the share price, because that's just
eventually the shares will eventually. The shares will eventually catch up.
Absolutely.
Right. So should we move on to another beverage maker?
Yes, let's move on to Hotel Chocolat. Sam, beverage, hot chocolates.
Hot chocolate's a beverage. I know they do mainly chocolate, but I'm trying to link it together. But yeah, anyway, so we have covered them once before on the show. They have come out with a trading statement. Yeah, so they have come out with a trading statement for the full year results, and total group revenue increased by 37% to 226 million, ahead of market consensus expectations, and by 70% compared to the 2019 year, with 2019 being the last full equivalent period prior to the impact of the pandemic. Second half growth was very robust at 32% against a stronger comparative in Q4 2021, following the end of lockdowns affecting UK retail from April 2021, when group sales growth began to accelerate. So group sales versus 2021 were up 40% in the first half, 32% in the second, giving 37% overall. And group sales versus 2019 were up 77% in the first half, 60% in the second, giving 71% overall. The statutory reported profit for the year is expected to be a loss, being affected by the outcome of an internal business review, predominantly as a result of non-cash impairment provisions and costs arising from discontinued activities, including the closure of retail stores in the USA. The group is well capitalized with cash on hand of 17 million and with 50 million of available undrawn headroom in the group's 50 million working capital RCF. Inventory products for the 2023 year is well advanced. They said, having raised 40 million new equity in July 2021 to support growth investments, the board has now reviewed the relative performance of each strategic growth driver over the year. Given the current global macroeconomic climate, the group will now deliberately focus its efforts over the next 3 years on its most proven and lowest risk strategies, with the greatest potential for further increased profitability and scaled cash generation. The forward strategy for each of the 6 growth drivers is as follows. VIP and loyalty and digital will continue, now forming a core part of the business as usual growth in the UK without requiring material additional investment in the near term. Velvetizer hot chocolate systems and velvetized chocolate cream alcohol continue as a capex light growth categories, with significant further UK market headroom and the potential for risk-contained capex light international wholesale growth. In response to the change to the global macroeconomic environment, investment levels in the US and Japan joint venture will be materially reduced, with ongoing investment limited to essential working capital only. The focus on profitable drivers will mean lower sales growth in the short term and some transitional costs, leading to lower profits in 2023. And then they've also talked about in operations, VIP loyalty customers now account for 71% of UK direct consumer sales by value, and that's up from 44% a year ago. They've also talked about the multi-year capital investment programme to deliver robust and scalable manufacturing and supply infrastructure, with UK factory capacity increased from 210 million pieces in 2019 to 380 in 2023 financial year, with a long-term ability to grow site output to 1 billion pieces with further staged capex spend. And they've highlighted the 9-fold increase in production capacity for unbelievably vegan milk chocolate. I also wanted to highlight Quality Compound James, who was also, he used to be known as the 20s trader, but he changed his handle on Twitter. We've got a couple of interviews of him from a few months ago, might even be like a year ago actually now, where he's still under the heading 20s trader, but he's definitely worth a follow on Twitter at Quality Compound. But he did a few tweets about the results, and he said the spiritual home of Hotel Chocolat is St. Lucia, where the company owns a £10 million luxury hotel and estate that management can book for themselves. The hotel incurs constant OPEX investment, and in 2021, an impairment of 216k. The estate delivers 600k revenue for the group. Management believes St. Lucia operations are critical to the hotel chocolate experience and brand value. I'd argue virtually none of the UK customer base is aware of any St. Lucia estate. To me, this is poor capital allocation, and Hotel Chocolat brand is so far removed from its St. Lucian message that there is no reason to keep it this way. Clearly not the only reason Hotel Chocolat is down big today when the statement came out, but put me off buying it. Yeah, I would agree. They probably don't need a £10 million luxury hotel for management.
I mean, I'm sure they think they need it, but
well, yeah. If I was a manager, I might make a different argument. But
the last thing to go.
Yeah, I don't think that quite. I don't know if that made it into the trading statement. Actually, they must have left that out unless he's found it hidden in the detail. But yeah, not particularly impressive. In terms of the valuation, obviously we don't have the earnings figure from this, and if it said it's going to be a loss, there probably won't be any anyway. But based on last year's results, it's at a PE of 30 and a market cap of 186 million. I mean, I don't know how I feel about this. The growth's impressive, but if they're cutting back on US and Japan, you're not going to get any international growth. And I don't know how saturated they are in the UK, because they've got tough competition in like Thornton's and whatever the other chocolate one is. There's 2 of them, isn't there? There's Thornton's and another. What is it? Is it Lind? Is that the one I'm thinking of?
If you look at it, if it's sort of bricks and mortar, retail or chocolatier, it is really only Hotel Chocolat, because Thornton's, I don't know whether it would have been 10 years ago or more, they went into the supermarkets, and then I don't know as a business what happened. They closed almost all of their stores. So then it was, yeah.
Oh, well, I only see the outlet stores.
Okay. So then you were just left essentially with Hotel Chocolat, which then grew massively and almost filled all of the Thornton spaces. And Thornton's, it was like they cheapened their brand and started selling in supermarkets, whereas Hotel Chocolat had the premium image. It was using, 60-70% chocolate rather than sort of literally diluting it. So I think it established itself almost in place of Thornton's.
It just feels to me like if you go to I know it's always going to be in the cities, but if you go to like York or Leeds or Newcastle, there's one already there. It's not like a Greggs where you think, oh, well, they can put one across the road because people are too lazy to cross the street.
And I would agree with you on that. It does feel like it's saturated in the UK. That's and I go a lot because it's kind of the only option or quality option that's on the high street.
Yeah, so I know they've got the new products and the velvetizers that they're talking about, but if it's priced, well, it's priced for growth. It's a very expensive stock, and if they're pulling out of the US and Japan, that growth can only come domestically, which I would struggle with that.
I mean, that's one would assume why the share price has sort of collapsed. I mean, it's down about 76% this year.
And I think a big drop in the last. Yeah, it's down 45% in a week.
Yeah, so I think that probably reflects, investors digesting that news, and that the US and Japan, they won't be savouring the news.
I mean, I think the last time we looked at it, I think the conclusion was it was expensive, but if they can deliver and the international pays off, then it could be quite cheap actually, and you can understand why someone might pay up for it. But it looks like they're not delivering on the international, so on that basis, it's probably quite expensive now.
It's quite expensive.
They could sell the St. Lucia Hotel to raise cash if they need to.
Yeah. I think on last year's numbers, it's 15 times earnings.
15 now.
Yeah.
Hargreaves is wrong. It's saying 30. I don't know if that takes the interim into account. I don't know. I think I remember it being about 30 last time, and if it's been more than cut in half, then 15 sounds more right. But if it's going to have a loss, it's actually going to be an infinite PE anyway. So
I was going to say it's ripe for a Mike Ashley takeover, so it's it'll be coming for them.
It's a bit too upmarket for Mike Ashley, I think. But I'm sure he could soon get that in every Tesco's in the country.
He's got. Well, it's not. I mean, he got Jack Wills, which was relatively upmarket, and he's building a stake in Hugo Boss. He's got.
Is he?
Yeah, he's got quite a big share of Hugo Boss. In fact, let me just Google that.
I don't like Hugo Boss. They designed the SS uniforms, Hugo Boss.
Yeah.
Oh, it's the bloke, not the brand.
Mike Ashley. He's got about. As of March, he had about nearly 15% of the group.
I reckon he's buying the dip in Hotel Chocolat.
Stranger things have happened.
Right, shall we move on to Netflix? Speaking of stranger things.
Yes, very good. Okay, so Netflix doesn't really need much introduction. It's our US company of the week. It's the American streaming platform, and they had a trading statement out for the second quarter. Revenue rose 8.6% to $8 billion, and this reflected a 5.5% annual increase in subscribers. However, the number of subscribers actually fell by 970,000 compared with the first quarter, although that was better than the guidance, which was guiding for a 2 million subscriber fall. If you look at things in a little bit more detail, the average revenue per membership grew in every region except Asia Pacific, with a particularly strong performance in Latin America. In the core markets of the US and Canada, average revenue was up 10% to $15.95. Total costs and expenses also grew significantly, with development and technology costs rising by over 33% to $716 million. The group spent $4.7 billion on content in the quarter. And Netflix is planning on monetizing the platform further, cracking down on account sharing and introducing an ad-tiered system. Free cash flow came in at $12.7 million compared with $175 million outflow. And on a 12-month basis, net debt came in at $8.5 billion. The group explained last quarter, we discussed our slowing revenue growth, which we believe is the result of connected TV adoption, account sharing, competition, and macro factors such as sluggish economic growth and the impact of the war in Ukraine. We've now had more time to understand these issues as well as how to best address them. First and foremost, we need to continue to improve all aspects of Netflix. In terms of valuation, Netflix has a market cap of $97 billion and trades at just under 18 times earnings, compared with a 10-year average of 112. I suppose these results were certainly better than the market was expecting, with a smaller drop in subscribers than was previously guided, but still it was down 970,000. And it's difficult to see where things go in the near term because the US and Canada are largely saturated, even though they're squeezing revenue growth or average revenue per membership. But that's less easy to do where the emerging markets and the sort of the faster growing markets like India, where they're largely relying on the sort of the free, but the ad service. And in the meantime, Netflix is having to invest heavily, and it's got that competition, particularly from Disney Plus, which has an infinite back catalogue. So while it will spend money on new content, particularly in the Star Wars universe, it does have that back catalogue and probably, well, definitely more valuable IP there. So it's a significant disadvantage that Netflix is at. And as people are being squeezed, sort of anecdotally, you know that it's one of those things that people are cutting back on. So yeah, difficult to see where things go in the near term. Probably not one for me. Sam, your thoughts on Netflix and these results?
Pretty similar to you. So it's actually, we've covered this quite a few times on the show, and I've actually probably become less bullish the more we've dug into it. I actually found it easier to justify when it was at 50 times earnings. But it's because it was delivering then. Whereas now it's just like you say, they're pretty saturated. I mean, I'm not sure what they're blaming the impacts of the war on Ukraine for. I know they've slipped it in there, but really any impact it's had to them will be minimal. So I think that's poor from management, really. They could accept some responsibility, and they could consider that maybe part of the reason is the content's not as good as the competitors or not where it should be. I was listening to, I think it was one of the Motley Fool podcasts, maybe like a month or so ago, and that was talking about how a lot of their top shows are now coming to an end. So I think Stranger Things is coming to an end. There's like one or two other of the big ones. And they don't really have anything coming through where it's been that viral, apart from maybe like Squid Games in the last year. But yeah, I mean, I've not had access to a Netflix account, which I've never paid for, by the way, but I did have access for like a good period. And I've not had access for about a year now. And there's a couple of shows I'd like to watch, but I can't say I've really missed it. And as well, like if I look at, I don't watch a huge amount of shows anyway, but if I look at my own patterns in terms of what I do want to watch, like I will watch any of the Star Wars shows. And for me, that is an event when they come out. I watched, have you seen the new trailer for the new HBO Game of Thrones one?
I have, yeah.
It looks very, very good. So like, I don't have HBO. I will be finding a way to watch that. There's nothing on Netflix where I feel like that, where it's like, I need to find some way of getting access to this. And I think a lot of people are probably the same. And there's so much competition now. You could subscribe to like Disney for 3 months and then end the subscription, and then subscribe to HBO for 3 months. And then by then Netflix will have a good few series you want to watch, and you'll binge through them and then cancel it rather than have it all year round. But I just think the competition's a lot better than it was 5 years ago, because the Disney brands are fantastic. And I know eventually you can dilute the brand to a degree, but I think if Disney put out a few Star Wars series every year, I will pay whatever it costs for Disney Plus within reason, and I will watch everything they put out. Whereas there's nothing really like that from Netflix, where it's like, come what may, I'm going to be watching that. They don't have the same pulling power, and it's like neither of us have kids, but like, if we have kids in the future,
it's going to be like Disney Plus.
It's going to be Disney. Like, no, like, I mean, it's like the example I always use when I tell people why Disney is the best business in the world. I know we're meant to be talking about Netflix, but it's like, how many of the listeners have seen Snow White? It'll be like the majority. And then I can't remember the exact, I think it came out in 1937. But name another film from 1937 that people still watch today. It's just ridiculous. And Netflix, the problem is their content will age a lot quicker than Disney's, because it just doesn't have that same magic to it. But yeah, I think 17 times earnings is probably the cheapest we've ever seen it, but it's probably for quite good reason now. I'd rather own Disney.
Yeah. And there's such a vast quantity on these on-demand platforms that I think you would just pay for the highest quality one. I think you get to a point where there's just too much to watch, and then you are just picking the very best things. Netflix, it's having to spend an awful lot to keep competitive. So, Sam, of the companies this week, which one would you choose?
I would probably choose Money Supermarket. If we're excluding it on the basis I already own it, I'd go with Britvic. I'd just pay up for it. Yeah, but it's not. I actually don't think it's been the strongest lineup this week. Actually, no. What about you?
I would go for Britvic, and my second choice would probably be Money Supermarket. Third, Frasers, and I won't go down beyond that.
It would probably be Netflix after that. I wouldn't really want Hotel Chocolat or Ocado. Ocado is going to be last for me, but
yeah, unless there are any perks, I don't know. Any perks for shareholders with the St. Lucia estate?
I don't know about the St. Lucia estate, but it's not going to be like the travel lodge, is it? Where you get like a free breakfast?
No. That's Premier Inn.
How is that?
Yeah,
I'll Google it, see if they've got any.
Yeah, sure. A box of chocolates, maybe.
I can't see anything. Nothing's jumping out in the Google search, so maybe nothing. Anyway, right. I think that's everything then. So thank you very much for joining us, and we'll see you all next week.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.